So over the last couple of months, I've started posting a bit more about my trading journey, and I've been absolutely bombarded on my Instagram about what my strategy is and what the framework is that I use to place my trades. So instead of answering all of you individually, which I do not have time for, I'm going to make this video to explain exactly what my strategy is, how I identify clean draws and liquidity, what is a draw and liquidity, and basically how I place my trades. So here is the basic layout of my strategy. I try to identify the higher time frame structure and build my bias around that structure. Then I identify internal and external liquidity pools within that structure. I wait for a retracement to take the internal liquidity, and then I wait for confirmation back towards the external liquidity for my entry. And then after, we have the trade management, which is where I go break even and how much risk I put on the table. If you do not understand what I said, that's okay. This is just for the more advanced traders who want to look at this and click off the video. But now I'm going to go more into depth with each individual point, starting with number 1, the higher time frame structure and how I build my bias. So the way that I build my bias when going into the session involves two main key things, which is market structure and high time frame fair value gaps. These are the two main things that I look at when identifying my bias. So to go a bit more in depth with market structure, we have two main types. We have bullish market structure and we have bearish market structure. That's very simply, we have bullish and bearish market structure. Bullish, we create higher highs and higher lows. Bearish, we create lower lows and lower highs. And then with high time frame fair value gaps, here, the time frames that I use are the 4-hour, 1 hour, and 15-minute time frames. These are what I call my higher time frames. These are the time frames which I cycle through at the beginning of every trading session, and I check for high time frame fair value gaps. I try to see if they're getting respected or disrespected, and then I align my market structure with it to find my general bias. So the first thing I do when I open up the chart is I go to the 4-hour time frame and check out what the market structure looks like. So for this leg here, we can see that we are bullish. We are pushing upwards. I don't really care about this entire structure. I just care about these individual legs, especially on the 4-hour, as my trades are fairly small. So let's cycle down to the 1 hour. On the 1 hour, you can see it in a little bit more detail, how we are pushing up, creating these swings, which are consistently showing bullish movement. And then when you cycle down even further to the 15-minute, looking at this specific leg here, you can clearly see even more that it's bullish. And then another thing which I also look for is fair value gaps. I look to see if fair value gaps are getting respected or disrespected on this leg. So on the 15-minute here, we can see a fair value gap here, which is getting pushed into, and then pushed up from, so it's getting respected. This one here is also getting respected. This one here is also getting respected. This one here, that's a bit of a confusing one, but this one here is also getting respected. When I say a fair value gap gets respected, what I am saying is that price comes up, creates a fair value gap, pushes back down into it, but the candle body does not close through it. Lots of people will say a fair value gap only gets respected when the wick hits it and the body does not close in it, like this. But I will also say that stuff like this here is the fair value gap getting respected even when the candle body closes in it, unless the candle body closes through it. Now I want to explain exactly what liquidity pools are and the difference between internal and external liquidity pools. So as we knew before, when we have this basic market structure with higher highs, higher lows being a bullish market structure, the place that liquidity rests is at the swing positions, at these highs and at these lows. This is where liquidity rests. I have an entire video explaining liquidity if you want to watch that, but for you to understand right now, liquidity rests in these regions. So if this chart here is the higher time frames such as 4-hour, 1 hour, or 15-minute, these swings will be your external liquidity. These are external liquidity pools. All of these. Bang, 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 bang. Because they are on the higher time frame. That is the major thing to understand. They are on the higher time frame. And then when you go on the lower time frame, this entire structure would look more like this. It would have lots of little changes in price movements. It would still overall be a bullish structure, but it will look much more complex on the lower time frame. It always looks more complex on the lower time frame. So as we know, these parts here are external liquidity. We can still mark them out on this time frame as external liquidity. This is still the exact same thing. So these positions here are still external liquidity, similarly to the higher time frame structure, but with the lower time frame structure, we get to see the internal liquidity pools, which are these smaller swinging positions, the smaller swinging positions that you would not be able to see on the higher time frame. And the time frames that I identify internal liquidity are anything under 15 minutes. Anything under 15 minutes where there are swinging positions such as these that you can see, I call these your internal liquidity pools. Different people have different definitions. Some people would say external liquidity is on the daily chart and internal liquidity is on the 1 hour. But for my strategy, what has worked for me is anything under 15 minutes is an internal liquidity pool. Anything over 15 minutes is an external liquidity pool. Now I'm going to show you from the same location as before where I would find internal and external liquidity. So we're on the 4-hour chart right now. Here's the swing, here's the swing, here's the swing, and this is going to become external. You can see that these are the major swings that are occurring on the 4-hour chart on this leg. And then when we go 1 hour, it gets a little bit more obvious. There are a few more extra swings which you couldn't have even seen on the 4-hour, such as that. This major one here could actually be condensed down into this, and this. But this is still what I call external. It's still all external liquidity as we are still on a higher time frame. When we go to the 15-minute, that is when it starts getting a bit sketchy. You can actually find internal liquidity on the 15-minute, such as this thing here. That is technically internal liquidity, but I still say 15 minutes a higher time frame for my general strategy. Just be a bit careful with it though. But the main thing is when you go to the 5-minute or anything below 15-minute, you can easily see internal liquidity. So we have this swing here, which we identified on the higher time frames as external liquidity. Inside of this external and this external, you have many little swings just constantly throughout it. And then on this trace back up from this external all the way to this external here, you again have lots and lots of little swings just constantly throughout the entire structure. You can mark out your external liquidity as when we go back here, the structure was external to external to external to external to external to external. But when you go inside, you can see that it's much more complex than that. There are many just little areas of internal liquidity, lots of little internal swings inside of this actual major structure, and everything that is below and sometimes including the 15-minute chart would all be identified as internal liquidity. Now I want to explain what a retracement is and how I take entries off of retracements once internal liquidity has been taken. So as I explained previously, how internal liquidity is these small swinging positions inside of the larger swings. Like here you have external, here you have external, 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 and everything inside of it is internal liquidity. What I like to see is a retracement. I like to see this internal liquidity being taken before I take my trade. And then I always take my trade towards external liquidity. So in this position here, I want to actually target this. As we are in bullish structure, I want to target this high for external liquidity. That is where I want to go. But the thing is, we are already there, so I can't really target it. So what I want to see happen first is us to push down and take internal liquidity. I want internal liquidity to be taken. We can just take that, or we can go and we can take that. We can take as much internal liquidity as possible. The more taken, honestly, gives better confirmation of your trade. But I just want to see this internal liquidity being taken. I don't really want to see external liquidity being taken, because once external liquidity gets taken, that has actually formed a completely different market structure. Higher high, higher high, lower high. That could be bad. But I want to see the internal being taken, and then I want to see it start to push back up. But the main idea for number 3, I don't know why this keeps moving, is retracement. I want to see the internal liquidity being taken like this before I start looking for confirmation of my entry. So after we have had the retracement, which took out some internal liquidity, it is time for me to look for my entry and look for confirmation to take my entry. So the confirmation that I use, as you saw up there, is a change character or an inverse fair value gap. Most of the time I like to use both. And I like to see change a character, which is also known as a market structure shift, if you've heard that before. And I want to see an inverse fair value gap on the 1 to 5 minute chart. So a change of character or market structure shift, very similar things, basically just means it's your market is turning from bullish to bearish, or the market is turning from bearish to bullish. It's just when it switches direction. And as you can see here, the overall external market structure is extremely bullish, but the internal market structure here is actually bearish. So for me to take my trade towards this external liquidity, I want the internal structure to also be bullish. So here, the market structure is bearish. Now I want to see it create a higher low and a higher high to switch the internal from bearish to bullish so that I can take my entry. And once it has this switch here, I also want to see a fair value gap being formed here and then inversed. And when all of this occurs all together, that has given me enough confirmation for me to take my entry, targeting external liquidity with my stop loss rather below internal liquidity or below our new external liquidity that has been formed. Now that I've talked about the confirmation and entries of my system, let's just go into trade management, which basically is where I go break even, like how I actively manage my trade when I've already placed my trade. So with this example here, I always like to place my break even points at internal swings. So we are targeting this external swing, but here we have an internal swing, and this internal swing I want to go break even once price hits it. So let's say price is here, keeps pushing up, goes to this region, then I'm going to bring my stop loss from here to here, and whatever happens from this position, if it gets me break even or if it goes and hits my take profit, is whatever happens. But the main thing is I want to go break even here, as once price takes this liquidity, there is actually a chance for it to reverse. And when it reverses, it will reverse hard, but it normally will hit your external liquidity before reversing, which is why I like to take trades towards external liquidity. But just in case, I like to go break even at the internal liquidity regions. So now that I've explained all the 5 major sections of my strategy, I want to show you some examples of trades that I actually took myself, and I'll break them down and show you how I thought about all these different pillars within the trade. So I want to show you some of the trades which I took during this period of time. I set up a FX replay chart, and I will just go through some of the trades I took and explain exactly why I took it, how I took it, and how it applies to my system. So let's go on the 18th of May. I want to show you exactly how this trade worked out. So as you can see on the 4 hour, from here, we are fairly bearish, creating lower lows and lower highs. The 1 hour shows it even more clearly. Let me pull up an arrow thing so I can show it a bit easier. So here we can see we clearly are bearish, and I'm expecting it to push even further down. So when you go into 15-minute, you can see that we inversed this 15-minute gap here, showing that we are respecting bearish and disrespecting bullish. The lower time frame, like I said before, is bullish, but it's a trick. It's not actually bullish. As I was saying, you want to follow the higher time frames, which are clearly bearish. And then my entry was about 20 minutes into market open. Price dumped down, and then it retraced back up. We pushed into this 5-minute fair value gap. I saw that we are definitely going to be bearish. I'm not expecting any sort of bullish movement. So I took an entry off of this, stop at this high, and my take profit was down at this liquidity zone here. And also, as you can see on this bullish push upwards, we had a swing here. So I decided to place my break-even zone at that exact swing. And then when we play out exactly this price action, as we can see, it pushed down, I went break-even here, and it just flushed. Ooh, that's sketchy. It did, okay, that's a weird candle, but it just flushed towards my take profit, as it should have. Alright, so we're on the next day, the day after, May 19th. I took this trade here. With this trade, I was supposed to take it all the way to full draw on liquidity, but I only needed a certain amount of money to pass my accounts, so I didn't take it all the way down. I just took it a little bit of the ways down. But on the 4 hour, we can or the 1 hour, so clearly see that we are bearish. Extremely bearish. Let's go 4 hour just to verify it. Bearish. Obviously bearish. So then go down to the 15-minute. What can we see here? We have a bunch of liquidity resting on this region here. And then we swept out all of that liquidity. We also swept out this internal liquidity. We just took a bunch of liquidity as the market opened, which is fueling a move downwards. Going to the 5-minute, what do we see? Nothing really. We just see that we swept this liquidity here, and we swept this liquidity here, exactly as my system says. Retracement, taking internal liquidity. We took this internal liquidity, and over here I saw a nice entry. We had a change of character here. No inverse fair value gap, but we had the change of character. That's enough for my entry, as my discretion was saying that this is a strong move. And this draw on liquidity down below here is extremely strong, as we are very bearish overall. And what did I say before? My trade management, I go break even at an internal swing. So here I liked to go break even, and I took my trade from this position on that change of character. And then my break even is here and my take profit is here, but I didn't go full profit as I didn't need to get my accounts passed. But if I was to take this now, I would go towards full profit, going break even here, and it flushing towards my profit as my system states. Now we're on to here, the 21st. This trade I did actually get break even in. I think I went break even a bit too quickly, but let's just do an analysis on it. So we can see that our overall structure, this is actually kind of yucky. Our structure is pretty choppy on the higher time frame, but it is technically still bearish from this swing. This isn't the cleanest example though, but the reason I took a short was we had this 1 hour fair value gap. We pushed up, we tapped into this 1 hour fair value gap. I'm targeting this liquidity down below here. And then I think there was a 3-minute fair value gap. Wanted to go break even here, but also as you can see, this is an internal swing that I went break even at. And here in this trade, there wasn't a strong change of character, but there was an inverse fair value gap. That was enough for me. So I took this trade, and my take profit I think would have been down here. This was a break even one. Still followed my system. We can see how it's not as clean as the others. That was a close call. Yeah, so here I would have went break even, and Oh no, that flushed me all the way through. Oh, I went break even. Yeah, I went break even before it even hit my break even zone. Yeah, so this is a part of my system. This one should have worked, but I actually had an error where I went break even on that candle before it even tapped it for some reason. So yeah, if you're following my system properly, you would have actually succeeded on that trade, but I didn't properly follow my system. So this trade here, I actually remember very clearly, as it was one of the most simple trades I've ever took. We are so clearly bullish. Look at the 4 hour bullish, 1 hour bullish. We are at actually all-time highs. This is the highest NASDAQ's ever been, all-time high conditions. On market open, we went down, we tapped into this 1 hour fair value gap, and we have an amazing push off of that fair value gap. The only issue for me was this 5-minute gap here, which I wanted to see get inversed before I took my trade, just in case it did something weird. So here we can see it got inversed, and I took the trade off of the 5-minute chart actually. So once this got inversed, I took my trade. My stop was about here. Let's see if it's protected on the 1 minute. Now I think that was a discretionary stop placement, just about here. And I went full TP up here. This one I actually didn't have a break-even placement until the trade already played out a little bit. So as we can see it running up, it edged my fucking profit. It just edged my profit. So I said, okay, once it goes back here, I'll go break even. And then it goes back up, flushes, and full TP. When you're at all-time high conditions, it's actually very easy to trade. You just long. Just keep on longing until you get proven otherwise. And now I'm going to show you the next trade I took. This will be the last one I'll show, but this one was actually a loss. I said it was an A+ trade in my description. It wasn't. Looking back at it, this wasn't even a part of my system, and I'll show you why. On market open, we dumped, we created this 5-minute fair value gap, and I took a short off of this 5-minute fair value gap and this 1 minute inverse fair value gap. But the issue here is when we go to the 1 hour time frame, we are bullish. When we go to the 4 hour time frame, we are so clearly bullish. You should never take a short. I'm pretty sure I just FOMO'd into this as price ran down without me, but we are so clearly bullish when you zoom out. When you zoom in, okay, yeah, we're bearish, but when you zoom out, you're bullish. You need to respect the higher time frame. So here we pushed up, we tapped this 5-minute fair value gap, and then we pushed down, we inversed it, not even a change of character. There was a change of character to the upside, not even a change of character to the downside. Looking at this is a stupid trade. I took a short here, I went break even here, and where was my take profit? I think my take profit was at this swing here. Yeah, the line you see marked there, I'm pretty sure that was this swing all the way down here, but I wasn't gonna trade all the way towards that one. So here, I took the trade. Stupid trade against the high time frame. Obviously got stopped out, and then what happens with price? Yeah, we went to my draws and liquidity, but look, this is a no trade condition. This condition here is no trading. If you have a day like this, just don't trade. It's disgusting. But anyways, I just wanted to show you how you can have losses in the system, but at the same time, this isn't even a part of my system. This was just a stupid trade because I went against the high time frame. But if we look back at my system, the main idea is high time frame structure, and then identify your internal and external liquidity pools, wait for a retracement to take out internal liquidity. I want you to target external liquidity with confirmation being a change of character and or an inverse fair value gap. Try to have both, makes it better. And then just have a good break-even placement, have good risk, and you're set. You should become profitable very easily if you just trade the system and don't do stupid shit. That's about it.